What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about something called the self-rental trap. So let's say you're thinking about buying a building and renting the space to your business. Very common strategy used by business owners. Well, to do this, you need to be aware of the tax laws around an area which we're going to call the self-rental trap. Now, as you probably already know, income and losses from rental activities are generally considered passive. It cannot be used to offset regular business income or W-2 wages. They can only offset other passive income or losses. So that's the general rule. Now, there's exceptions to that rule. For example, qualifying as a real estate professional. There are certain short-term rentals that allow you to treat the income or losses as non-passive. But overall, in general, losses by default are considered passive. Now, what is a self-rental? In the eyes of the IRS, a self-rental situation occurs when a taxpayer owns an operating business in which they materially participate, as well as the real estate used by that business, and the business and real estate are separate entities, the business paying rent to the real estate entity. That's what's going to generate this self-rental trap. So the operating business owned by you, the taxpayer, paying rent to the real estate, also owned by you. Now, for asset protection purposes, generally, these are going to be two separate entities. That's when you run into this self-rental situation. Now, self-rentals get a raw deal. So what happens is, as you know, with normal rentals, there are some hurdles you have to clear before you can deduct those losses. For example, qualifying as a real estate professional. Well, the tax code imposes even higher hurdles when it comes to a self-rental. So if the self-rental produces income, that income is considered non-passive. So this destroys the hope of using your rental income from a self-rental to absorb passive losses from other investments. It also makes this income all taxable. So even if you own other rentals with losses, your self-rental has income, you can't net the two. You're going to pay tax on the self-rental income, and your passive losses are still going to be suspended. Now, if the self-rental produces a loss, the loss is considered passive. So this suspends the loss, probably going to add it to other suspended losses if you have any. So this self-rental trap, if you will, kind of gives you the worst of both outcomes. So the worst of the income by treating it as non-passive, and the worst of the loss situation by keeping it as passive. So it might help to just briefly to talk about an example. So let's say Bob owns a business, ABC LLC. He also owns the building from which it operates. We'll call this Building LLC. ABC LLC pays rent to Building LLC. Therefore, Bob has a self-rental. But Bob also owns other rental properties. They produce passive losses each year that are suspended. If Building LLC has a loss, it's also suspended and trapped out there with the other suspended passive losses. Cannot be deducted from Bob's income unless there's some passive income out there that can absorb some of this. If Building LLC has profits, then the income is considered non-passive and cannot offset the losses from his other rentals. So this is the default treatment for a self-rental. Now, there is a solution. So there's a special grouping rule that allows you to treat the business and the self-rental as one activity for purposes of the passive loss rules. So the owner of the business needs to have the same proportionate ownership in the rental activity to make this election. So when that happens, so in our case with Bob, he owns 100% of ABC LLC and the Building LLC, they can be grouped together and treated as one single activity. So you could find the mechanics of how to make this election in Revenue Procedure 2010-13. All it is you attach a statement to your return. So the statement's going to identify the name and addresses, EINs for the business and rental activities that are being grouped together as one single activity. So let's go back to our example with Bob. Luckily, Bob learned about the self-rental trap before filing his taxes. He made the election to group ABC LLC and Building LLC as one single activity. And now he can use the losses from Building LLC, in the event there's losses, to offset the income from the operating company. Now, the losses from his other rentals, they're still stuck out there in the passive bucket and handled separately, but the losses from his self-rental can be deducted against his business income. Now, if the self-rental still produces income, then there's really no advantage to this. But by keeping, if you have control over, if you have the entity, the business and the rental grouped together, and your rental produces losses, which it easily can do with depreciation, you can offset those losses with your business income by making this election, and you get yourself out of that self-rental trap. So basically what this grouping election does, it treats the rental losses as non-passive and the rental income is still non-passive. So you can't avoid having that rental income treated as non-passive, but you can treat the losses as non-passive with the grouping election. So just think of it this way. With the grouping, you have one single activity for tax purposes. Any income or loss from the grouped self-rental is simply part of the business and treated the same for tax purposes. So if this situation applies to you, you run an operating business, you own the real estate from which it operates, make sure you've got that election in place and you don't fall victim to the self-rental trap. Now, when it comes to making the election, you're technically supposed to make the grouping election in the first tax year that you run into the self-rental situation where you have the operating business and the rental activity grouped together as one. Now, by default, if you're engaged in two or more trades or businesses or rental activities and you fail to report the grouping as a single activity, then each activity is going to be treated separately. Now, however, and this is right from the revenue procedure, in section 4.07, it says, notwithstanding the previous sentence, which is essentially what I just stated, that each activity is considered its own separate activity without the election made. However, a timely disclosure shall be deemed made by the taxpayer who's filed all affected income tax returns consistent with the grouping of the activities if they make the required disclosure on the income tax return in the first year they detect that this disclosure has never been made. So what that actually is saying is, if you haven't made this grouping election, maybe you've been treating your self-rental as if you made the election. If you never have, you can still make the election, make it on your next tax return, and then you'll be in good standing. If the IRS discovers the election was never made, for example, if you're under examination, then it's too late. They're going to be separate activities. So if you have a self-rental and you haven't made this grouping election yet, make sure you do so on your next tax return. So that about does it today for our discussion on self-rentals. If you found value in this, please leave a comment or hit the like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.